Good morning. This is Bloomberg Daybreak Europe. I'm Joanna Bersetchi in Dubai, and these are the stories that set your agenda. Travel chaos. London's Heathrow Airport is forced to close after a fire at an electricity substation. Passengers are warned of major disruption over coming days. Tariff jitters. Uncertainty weighs on the markets as the White House reiterates that the big one is coming on April the 2nd. Plus, no deal. European leaders failed to agree on delivering 5 billion euros to Ukraine to buy ammunition. Good morning again, everybody. Good morning from Dubai. And for those of you waking up in London to news that Heathrow Airport is closed, we're going to get to that all-important story in just a few moments. As ever, kicking off the show with a look back at markets. We saw a bit of a dip yesterday in terms of risk sentiment, taking a bit of a nosedive. Wall Street, a pullback for both the S&P and NASDAQ. Today, you are seeing somewhat of a similar theme play out. Heading into the European session, we've got Euro Stoxx futures leaning towards the red, down 0.5%, perhaps on the lack of an agreement at the EU Leaders Summit vis-a-vis putting forward that 5 billion euro ammunition package towards Ukraine. We'll talk more about that later on the show. FTSE 100 leaning slightly towards the green despite the outage at Heathrow Airport. So this is the picture for that market. And then S&P futures, NASDAQ building on some of the losses from yesterday, down about 15 basis points, 0.2% respectively. Also, just to point out, the S&P is technically back in correction territory again. So we are down 10% from the peak reached in January. So technically back in correction territory after dipping yesterday in trade. Switching over, though, to cross assets, and let's take a look at how some of the other key financial instruments are trading. 10-year U.S. Treasury yields also in focus, back to 4.25%. And remember, the reaction was quite a dovish interpretation of that FOMC meeting earlier this week. So we have slid lower throughout the course of this week. 4.25 is where we are right now. The euro also slipping a little bit in trade this morning, down 0.2%. No doubt concerns about tariffs, the global growth outlook weighing on the currency here. And then the pound also down about 0.3%. Let's not forget we had that Bank of England meeting yesterday. No fireworks, but the market was a bit surprised to see that vote split and that members who had prior been calling for a rate cut had changed to no cuts. So somewhat of a mildly hawkish surprise coming through there, but the pound slipping today in trading. And then Brent also in focus. We're trading back above $72 here on news that the U.S. has been tightening sanctions once again on Iran, applying sanctions on a Chinese refinery. So it's all part and parcel of the maximum pressure campaign that DC is applying on Iran. So that is transpiring in energy space this morning. But let's get back to the top story of the day. London's Heathrow Airport will be shut all day Friday after a fire caused a significant power outage, throwing one of the world's busiest airports and the travel plans of hundreds of thousands of people into chaos. Let's go to Bloomberg's Guy Johnson in London. Guy, so just tell us what we know. What is the latest from the airport? How are these authorities actually responding to the fire?
So there's a fire nearby. It's not actually at Heathrow, Jemana. It is at a substation close by, but it's taken out power to the entire region, and as a result of which Heathrow is caught up within that. So we are now expecting Heathrow to be closed all day. It will, according to the latest reports from Heathrow, open at midnight tonight, but that at the moment is unconfirmed in terms of that being a final moment for Heathrow to be able to reopen. But it is going to be closed all day. The latest from the power company seems to indicate the power will be restored by around 3 p.m. This afternoon. This is, as you say, one of the world's busiest airports. It is potentially the second busiest airport on the planet. 1,351 flights are due in and out of Heathrow today. 700 of those are for IAG, the owner of British Airways. It will be severely affected, but other flights around the world are going to be affected as well. Air India indicating that it's turned aircraft around. A number of aircraft coming out of the United States have been been turned around. Qatar is indicating that it has 6 flights currently being impacted by this. We'll see what Emirates has to say a little bit later on. So big airlines are being affected. Obviously, this is kind of the first wave of aircraft that would be arriving kind of around now into Heathrow. It's a huge moment. We have seen similar incidents in the past, but this is the last I can remember where Heathrow has been shut as a result of a fire, as a result of an electrical shutdown. We haven't seen this, and clearly questions will be asked about just how much redundancy there is at Heathrow and the ability of a major airport to keep functioning with a power outage, I think is a key question.
Yeah. And Guy, you just ran through some of the responses from key airlines from around the world, Emirates, Qatar, of course, British Airways too. But just put it into context for us, given how busy an airport Heathrow actually is, how much of a global impact this could have on travel? How much disruption could it cause worldwide?
So it's going to cause enormous disruption worldwide, Jemana. So you think about... So I was just running through what's happening right now. The ripple effect of that is enormous around the world. It's going to not just affect Heathrow, it's going to affect every major airport around the world, simply because aircraft will not be where they are supposed to be. They were meant to come into London, they were meant to go back out of London, they're meant to be somewhere else. These aircraft are constantly in motion and being used. So the fact that you've got 1,351 flights not taking place today means that lots of aircraft are going to be in the wrong place. So this isn't going to be isolated to just Heathrow. It isn't going to be isolated to just the UK. It is going to have a ripple effect around the planet that could last for days and days and days. Even if Heathrow reopens at midnight tonight, the effect could last 2 or 3 days. It will take a long time for global aviation to reorganise itself, get aircraft in the right place and sort itself out.
Well, those affected include our EMEA head of TV, who seems to be stuck in Dubai, Bloomberg's Guy Johnson in London. Thank you so much for the latest there. And you can also get commentary and analysis on the situation at Heathrow on the Bloomberg terminal at TLive Go, a great resource today. All right, let's pivot back to markets and take a look at how Asian markets are faring with Avril Hong in Singapore. And Avril, we've been talking about the risk-off sentiment that's gripping some of these markets overnight. Just walk us through the price action in Asia today as well.
Yeah, I think the risk-off has certainly heightened as the session progressed. I think the tariff uncertainty and how it's continuing to cloud the global economic outlook is really outweighing any Fed relief we had a sense of earlier in the week. And of course, today we're seeing that reflected across the region. Even the Japanese benchmark, which earlier managed gains of 0.6% flat, now Hang Seng sliding deeper into negative territory, extending gains for another declines for another day. And of course, this is against the backdrop of some of these bearish calls that have been re-emerging on Chinese stocks this week, including from B of A. Take a look at this next chart that will show you how the Hang Seng China Enterprises Index, this is a gauge of Chinese shares in Hong Kong, is on a 3-day decline. And actually, this could be its worst since November last year. Amid the tech earnings this week that have been looking quite solid, I think another point to note here is, and analysts have been raising how the valuation gap with the US has actually narrowed given the recent correction on Wall Street. So maybe for Chinese stocks, they need to do more than just look attractive on a valuation basis. And the movers today include the ones that have been the biggest boost in the Chinese stock run-up, including the likes of BYD and Alibaba. Now flip the board and take a look at how FX is faring as well, because we are seeing that slight firming in the US dollar. So most Asia currencies on the back foot, including the yen. And this is despite data today that backs the case for a BOJ rate hike. Renminbi has been in focus. We saw the dollar-yuan fix today at the highest since Trump's inauguration. And this is despite the Bloomberg Dollar Index falling about 2% over that period. And that, to the likes of MLive's Mark Cranfield, feels a bit like preparation for tariffs, especially as the clock ticks down to April 2nd.
Hong in Singapore, thank you very much. White House Press Secretary Caroline Leavitt is repeating the warning from the Trump administration that further tariffs will come into effect on April the 2nd.
The president has been very clear about his intention for April 2nd. It's going to be a big day for our country. I would encourage all of you to be here to cover the White House that day on April 2nd, because there will be big announcements when it comes to reciprocal trade. And the president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly. And there will be big tariffs that will be going into effect.
All right, let's bring in Bloomberg's Valerie Teitel. Valerie, good to see you. So we've been talking about this potential big tariff deadline on April the 2nd. How much is it actually weighing on markets that you track?
Jumana, it knocked risk sentiment in the afternoon yesterday when Caroline Leavitt repeated that warning of big tariffs to come on April 2nd. We fell off the highs in the S&P 500 and actually ended the session in the red. However, if we look on a weekly basis, Jumana, there is some good news. The S&P 500 is looking to snap its 4 weeks of losses, but there are some risks ahead, some of which being some single stock movers that reported after the bell yesterday, one of which being FedEx, which is known as a bellwether for U.S. economic growth. It actually came out with a profit warning. It's now its 3rd quarter in a row that it's reduced its 4-year guidance. So after hours, that stock sunk 5.6%. Moving on to Nike, we also heard from them after the bell. It looks like the CEO's turnaround plan is not going very well. There is still an inventory glut that Nike is dealing with. They also warned that margins could be impacted in the 1st quarter due to mounting tariff risks, especially with their suppliers into Canada and Mexico. So Nike shares down 5.2%. Some good news, though, when it comes to tech. Micron Technology had an upbeat sales forecast driven by AI demand. That stock was actually up as much as 6% in the after-hours trade. It's come off that a bit, but still in the green, up 1%. The other thing we also have to keep our eye on today, Jumana, it is the triple witching option expiry event. We have options expiring for the quarter from single stocks to indices and ETFs as well. Watch out for a surge in trading volumes in the afternoon session as we near these option expiries. Sometimes it causes quite a jarring vol to move in some illiquid single stock names.
Yeah, triple witching. So let's watch out for the last hour trade on the S&P today. Bloomberg's Valerie Teitel, thank you so much. Now, President Trump says he will soon sign a natural resources deal with Ukraine. The agreement fell apart last month after a tense meeting between Trump and Ukrainian President Volodymyr Zelensky. Bloomberg's East Asia government editor John Herskovitz joins us for more. John, just tell us about the contours of the deal. What exactly is going to be in it? How does it work? When is it likely to be implemented? What do we know?
Sure. President Trump said that the deal will be signed soon. No specific date given for it. And the basic tenets of the deal is that mineral resources from now will go, the earnings from these will go into a fund. 50% from Ukraine of this money will be used for reconstruction. So the things that Ukraine has, which may be mined, are things like iron ore, coal. These are things that are being mined in the country now and could be part of this. What President Zelensky had wanted was some sort of security guarantees that come with this. But the deal is supposed to be designed to commit the U.S. to long-term investment in Ukraine and make sure that Ukraine is paying into a fund that pays for its reconstruction. So same deal pretty much as what was there in February, supposed to be coming soon. And this comes on the same day that President Trump announced an executive order to speed up the mining of critical minerals and rare earths in the United States, trying to get these things which are essential for the economy and also the rare earths which are used for technology, batteries, really important stuff, trying to, I think, to decrease the dependence of the U.S. on supply chains from China, which supplies a lot of these minerals.
Yeah. Yeah. Well, speaking of China, President Trump is denying a New York Times report that Musk will be briefed on plans for any potential war with China. What do we know about that story?
Sure. The New York Times reported that Elon Musk would go to the Pentagon on Friday and be briefed on the operational plan for a war on China. The operational plan is sometimes called no plan. These are some of the most classified things that show how the U.S. expects a war to unfold and how it would be fought. Trump said that this was absolutely ridiculous, denied that this was going to happen. Defense Secretary Hegseth said that Musk is going to the Pentagon, also denied that he'll be briefed on the the O plan for China. But it also brings into focus the broad sweeping nature of Musk's role in the government and in the private sector. And he's being shown the fact that it's being considered that he could be seeing these O plans is one thing, but Musk also has lots of business operations in China. Tesla, his electric car company, manufactures there, sells tens of thousands of vehicles, and Musk wants to remain in the good graces of the Chinese government so he can keep doing business there. So there's a lot going on. We'll see what happens tomorrow, but denial on the White House, and New York Times still has his story.
Yeah, and certainly it's probably feeling a bit of a heat due to the price performance of Tesla stock this year. One of the, actually the worst performing stock on the S&P 500 year to date. Bloomberg's East Asia government editor, John Herskovitz, thank you so much. Well, a look ahead to what we're going to watch out for today in terms of data. We have got the public sector borrowing figures of the UK that comes out at 7 a.m. UK time. Later on at 1 p.m. we've got the Fed's Williams, who will be speaking as well. So watch out for any clues. Obviously, the FOMC meeting took place this week. Steady the course. It'll be interesting to see what the outlook is in terms of further interest rate cuts for the rest of this year. And then later on, at 3 p.m. UK time, we're watching out for EU consumer confidence, and also there will be interesting to see whether it's taken a bit of a hit given the uncertainty around the investment environment and potential tariffs. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayB, so DAYB, go. And of course, today we are leading with the story that there is disruption at Heathrow Airport. Now, coming up, the EU fails to agree to military aid for Ukraine as leaders grow concerned about being left out of US-led efforts to end the war. We'll have the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. EU states have failed to agree on delivering €5 billion worth of ammunition for Ukraine this year. Leaders meeting in Brussels yesterday also tussled over who should represent the bloc in potential US-led talks with Russia to end the war. Ukraine's president says his country urgently needs weapons now.
It's crucial that your support for Ukraine does not decrease, but instead continues and grows. And this is especially true for air defense, military aid, and our overall resilience. We need funds for artillery shells and would really appreciate Europe's support with at least €5 billion as soon as possible.
Bloomberg's Oliver Crook joins me now from Brussels. Well, interesting, Oliver, because Europeans have seemingly been looking to present a united front. What did we get, or actually fail to get, from European leaders at the summit?
Yeah, Jumana, I think that united front still stands sort of broadly speaking, but it is beginning to show its cracks. And though we will say that support for Ukraine has not diminished, I think it's fair to say that it is somewhat stagnating, particularly in the face of the kind of wait-and-see approach that the Europeans are basically forced into by the sort of bilateral nature of the discussions that we've had between President Donald Trump and President of the Russian Federation, Vladimir Putin. And basically now these leaders were basically failed to put together a sort of proposal where we were hoping earlier in the year from the High Representative, they would talk about potentially a €40 billion package. That was trimmed down to a €20 billion package. Then there was a €5 billion package potentially on ammunition, and they failed to sort of conclude on that. So this was an EU leaders meeting that was much more like a sort of meeting that you have in regular times, not emergency times, where they're dealing with a lot of EU business, which is also urgent, right? They're talking about competitiveness. They're talking about a number of other issues, but the sort of urgency of Ukraine seems to have dissipated a little bit and also brought to bear a lot of the cracks that we see within the European Union, namely led by Hungary. This is the second European leaders meeting where you actually had two different sort of set of conclusions, the main EU conclusions and then the conclusions on Ukraine that were joined only by 26 members without Hungary. So again, bringing into the fore some of the sort of issues that you're seeing here for the Ukrainians and for Volodymyr Zelensky, who really needs as much support from his allies as is possible. Now he sort of failed to get some of those concrete proposals from the European leaders from this meeting.
Yeah, meanwhile, earlier on, we were talking about Ukraine agreeing to sign that minerals deal with the U.S. But of course, at the crux of the matter is they still need military assistance. So where does this all leave Ukraine right now?
So I think what's interesting is we're starting to see some of the issues at the EU level where you have a lot of the negotiations. These are sort of hallmarks of the EU, right? This is a large democratic institution with 27 member states. So there's a lot of disagreements, a lot on political resolutions. What we are seeing now, and we got this piece of news yesterday, is that actually there's going to be another meeting next week in Paris. This will not be an EU leaders meeting. This will be a so-called coalition of the willing meeting. This is the sort of countries that will electively choose to help Ukraine on a number of issues, particularly on the question of security guarantees and continuing support into the future. So this is a meeting that, for example, does not include Hungary. It does include representatives from the United Kingdom, potentially, Canada and Japan, and coming together and trying to see what they can do more concretely for Ukraine in the short term in these sort of negotiations. Remember, this is a format that is spearheaded by Emmanuel Macron and Keir Starmer, and really trying to get to a place where the Europeans are really trying to find their place in these discussions. Because right now, as we were just saying, Jumana, this is a conversation between Vladimir Putin and Donald Trump. It is not a conversation that includes the Europeans. And for the Europeans, they feel like they're in the passenger in a car that is being driven by somewhere else. And where that car arrives is going to be their problem ultimately. So what they need to do is try to present a menu of options to Donald Trump and to sort of this conversation about negotiations so they can get their voice at the table and so that they can offer something in terms of enduring security guarantees for Ukraine.
Yeah, and just to pick up your analogy, hopefully that car actually does get to that final destination. Bloomberg's Oliver Crook, thank you so much for the reporting. And later this morning, Oliver has an exclusive interview with the Lithuanian president after 9 a.m. London time, and then a conversation with the Irish Prime Minister, Micheál Martin. So plenty more to come. This is Bloomberg.
Wednesday, UK Chancellor Rachel Reeves delivers the government's spring statement. How will she fix the hole in the UK's finances after her fiscal headroom was all but wiped out? And will she be able to keep her own fiscal rules? Live from Westminster, Bloomberg Television has special coverage, starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Now to some of the other stories making news. Israel's domestic intelligence chief has been fired after the Israeli cabinet approved a proposal by the prime minister to dismiss him. Ronen Bar, the head of Shin Bet, had often clashed with Benjamin Netanyahu over Israel's multi-front conflict. The move to dismiss him came despite protests by more than 100,000 people in Jerusalem over the past 2 days. President Trump has signed an executive order to largely dismantle the education department as part of efforts to overhaul the U.S. government. The aim is to cut the department's workforce by nearly half. But it faces legal and logistical hurdles, including potential clashes with labor unions and lawmakers.
We're going to be returning education very simply back to the states where it belongs, and this is a very popular thing to do, but much more importantly, it's a common sense thing to do, and it's going to work.
And the NVIDIA CEO says he didn't know publicly traded quantum computing companies existed when he made comments that caused industry stocks to crash. Jensen Huang said in January that he thought quantum computers were probably decades away. He's now announced plans for NVIDIA to invest in the technology. And coming up, stocks stumble on concerns about the global impact of President Trump's tariffs. We'll be speaking with Melanie Debono, senior Europe economist at Pantheon Macroeconomics, next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Jumana Versace in Dubai, and these are the stories that set your agenda. Travel chaos. London's Heathrow Airport is forced to close after a fire at an electricity substation. Passengers are warned of major disruption over coming days. Tariff jitters. Uncertainty weighs on the markets as the White House reiterates that the big one is coming on April the 2nd. Plus, no deal. European leaders failed to agree on delivering 5 billion euros to Ukraine to buy ammunition. All right, let's get you up to speed on how these markets are faring this morning. And of course, if you're just waking up to news of the disruption at Heathrow, we're going to bring you the latest of what is exactly going on there with that power outage affecting many of the airlines operating into and out of the airport. Obviously, very busy airport. So a major story in the world of travel. But let's just take a look at how some of the key equity markets are trading this morning as the world gets gripped by a bit of a risk-off sentiment in the last 24 hours. Week handover from Wall Street last night. That's panned out into the Asian session. This morning, European futures also leaning towards the red, down 0.4%. FTSE trading sideways. Remember, we had the Bank of England meeting yesterday. No surprises there, but perhaps slightly more cautious on the interest rate outlook ahead. And S&P futures, NASDAQ also leaning towards the red as well, down about 0.1%. Watch out for Fed's Williams speaking later today, the first time we hear from a Fed official since that FOMC meeting earlier this week. In terms of cross assets, this is what we're getting across some of these key instruments. 10 U.S. Treasuries trading at around 425. So slight upward movement this morning, 1.5 basis points. The theme, of course, the last few weeks has been one of a relentless slide in yields. But the bonds rally continues even after that FOMC meeting. So let's keep track of what goes on with those yields. Euro also trading slightly weaker versus the USD today, trading close to 108 handles, so about 0.2% softer. The pound also slipping despite perhaps the Bank of England deciding to stay the course and despite that 8-1 split on further interest rate cuts. But the pound, as you can see, is trading below 130 today, 0.3% weaker. And then Brent back above $72, about 0.2% firmer. This on geopolitical premium, with Washington deciding to apply sanctions on a Chinese refinery last night. So that is having an impact on the energy complex. And this, of course, directed at Iran. Now, let's recap the top story of the day with the travel chaos from Heathrow. The airport, which handles 200,000 passengers a day, will be shut all day Friday after a fire caused a significant power outage. A range of airlines are announcing a hit to operations, including Qatar Airways, Air India, and Virgin Atlantic. The airport is a major hub for transatlantic travel, as well as connections into the Middle East and Asia, so it will have severe impacts to global travel. And you can also get commentary and analysis on the situation at Heathrow on the Bloomberg terminal at TLive Go, a great resource to keep track of all of the developments out of Heathrow this morning. Now, this week's central bank meetings appear to have raised more concerns about the outlook for the global economy. Let's bring in Melanie Debono, senior European economist at Pantheon Macroeconomics. Good morning to you, Melanie. Great to have you with us on the show. Well, we did have a whole bunch of central bank meetings this week, and the commentary is just as I was saying, somewhat mixed about the direction of travel for the global economy, a lot of uncertainty around tariffs. But SNB was one of the central banks that did have clarity of thought, because they did go ahead with that 25 basis point rate cuts yesterday. What do you make of the decision out of the Swiss National Bank?
The Swiss National Bank was always likely to cut because since its last meeting in December, inflation has continued to fall. And in fact, it was only 0.3% in February, therefore moved dangerously close to the bottom of the central bank's target, which is essentially between 0 and 2%. The good news is that inflation actually came in slightly higher than the bank had expected so far in Q1, and therefore it didn't need to repeat the 50 basis point jumbo cut that it did in December. The outlook for the central bank now is, of course, wide open. We had thought that perhaps it would take a slightly hawkish tint, signaling that perhaps this is the end of the easing cycle and therefore the end of the road for rate cuts in Switzerland. We still believe that, but given that it did not change its forecasts much yesterday, it only raised them by a small amount, and that the statement was no more hawkish than December, June is now pretty much wide open.
Yeah, interesting. And obviously it ties into broader dynamics in Europe as well. Let me take it to Europe and how you're thinking about the growth outlook for the rest of this year. On one hand, you've got negative drivers coming from the potential imposition of tariffs, that big April 2nd deadline. But on the other hand, you have the big fiscal boost coming from Germany. So how does it pan out?
For us, we think that growth is now rebounding in the Eurozone, so European growth is doing well. But of course, there is the risks that are coming in Q2. Surveys of investor sentiment responded very well to the announcements of greater defense spending from both Germany and on the EU front. And this will likely raise our business surveys for March. But then we have to be prepared that these will simply reverse on April after what we know Donald Trump is aiming to raise tariffs on April 2nd for the EU. At the moment, what we're seeing is that these tariffs are creating great uncertainty. We think that the boost from greater defense spending will offset the small hit that we foresee from the tariff increases. And that's because we're assuming, again, it's very uncertain, but our mainline assumption is that the U.S. administration will go down the route of reciprocal tariffs on the EU. What that means is that the U.S. will match tariffs on all goods. If the EU is charging 10%, the US will charge 10%. The reason why we think this will not have a big impact on exports is because the EU has already come out and said, if that's the way we're going to go, then we will lower some of our tariffs and meet you halfway, or, at this point, not stay where we are. So what we're going to see is a hit to exports, but we think that will be offset by greater defense spending. So for now, we think that the Eurozone economy will continue to grow.
Yeah. I mean, still plenty of uncertainty about what they're going to do. And even yesterday, another deadline pushed back, the reciprocal tariffs on steel and aluminium, EU saying now that they're going to wait to impose them by a couple of weeks. So there's still that as a big question mark. Let me ask you about the fiscal bonds outlook for European nations, and specifically Germany. We have seen a massive jump in yields across all of these European nations, even though the main story came out of Germany. Do you think that Bund yield rise is, one, justified, and two, are we likely to stay around these levels?
We think that Bund yields will actually climb higher. The greater defense spending has to be funded in some way, and at this point we think that it will be funded by greater debt. And for that to happen, if the German government has to issue more bonds, then we're going to see bond yields trend higher. And in fact, at the moment, we see them probably peaking at around 3 to 3.25% by the middle of next year. So yes, yields will rise because of the greater defense spending, assuming it is going to be debt fueled. But that's not a worry, at least for the ECB. It won't be responding to debt, to higher yields.
So here's a question for you. If Germany was the country coming out with this big defense and infrastructure spending plan, why did the yields of France and Italy also rise in conjunction?
It's not just Germany announcing greater defense spending. There are other countries who are obviously pushing towards building up their armies again because of the threat coming from next door, from Russia. But also because they want to appease Donald Trump on the other side to make sure that they're meeting their NATO requirements and raising that spend to the minimum required of 2% of GDP, which looks like it's going to be raised anyway. But it is a wider effort in Europe to spend on more defense, as we've seen from the EU also now deciding to be more lenient on the new improved fiscal rules that only just came in last year, saying it's okay if you spend more on defense. We won't count that towards the glorious budget deficit limit. So it is a wider effort, and therefore we will see yields rising across the board. Of course, what we will see is what matters here is spreads. So if we think that spreads will fall, which we do have, for example, for Italy, then yields in Italy won't rise as much as Germany, but in general, they will all rise together.
The glorious budget deficit targets. Melanie Debono, great to have you with us on the show. Thank you for articulating your views on what happens next with the European economy. Senior European economist at Pantheon Macroeconomics. Well, coming up, a warning on the growing risk of shocks in the debt market as borrowing and interest rates continue to rise. I'll speak to Carmine de Noia from the OECD next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. The OECD is warning of a rising risk of shocks in the debt market as governments and companies borrow more than ever. Sovereign and corporate borrowing hit $25 trillion last year. That is almost triple the amount in 2007 before the global financial crisis. I'm joined now by Carmine de Noia, Director for Financial and Enterprise Affairs at the OECD. Good to have you with us, I should say. One of the highlights from your report also on sovereign debt issuance I thought was quite interesting. Big jump up between 2023 and 2024, a rise in almost $2 trillion. That's expected to increase by another $1 trillion this year in 2025. What are the main countries that are issuing more debt? Which countries are driving this increase in sovereign borrowing?
I would say that is a general trend, and then is a general trend that we have, we have this massive amount of government bonds. I would say both in advanced and in emerging economies. I would say proportionally. The thing is that this was maybe also structurally the right response to the big crisis that you just mentioned, in 2007, and then obviously COVID. But what is important, and the feature that we underline, is that after this jump in the crisis, we didn't go back to normal, but actually we remain at a plateau which was much higher. I think that basically this 25 trillion that is the issuance in this year is much higher, is 10 trillion higher than the average before in 2015, 2019, which is, the GDP of Japan and Germany together, which is a big amount.
Yeah, but even though this debt has been rising, we are not seeing further incidents of debt distress, which is surprising given an environment of higher interest rates. So what do you think is more important for the outlook here, the total volume of global debt or actual debt servicing costs?
I would say debt per se is not necessarily, bad. I mean, debt is important sovereign, and is important corporate. Corporates, access market, even the riskier one, taking also advantage of the low interest rates. Now, the issue is that the most important thing that also we underline is that servicing cost. Basically, this huge amount of debt has been issued with very low interest rate. Today, more than 50% of sovereign debt basically has a cost of refinancing which really higher than the cost that it was issued. We use as a proxy the yield. So this is a big issue. And this is, coupled by the fact that a lot of this debt is going to expire in 3 years. So there is very, short term, and the cost of refinancing will be high. And these may cause, especially for some categories of issuers, some problems, emerging markets, and also maybe riskier corporates.
Yeah, what have you seen in terms of the maturity of the bond issuance that's coming from these sovereigns? I remember, one of the discussions that took place throughout 2024, there was a lot of analysis scrutiny of the U.S. Treasury, the then U.S. Treasury's decision, Janet Yellen, to issue more short-term securities. Is that a trend that was followed by other parts of the world as well?
I would say that in the last years, debt managers' office, that they did a very good job. They tried to lengthen, the maturity of the debt, also taking advantage of the low interest rates. Now, the issue is that with this uncertainty, increasing geopolitical tensions, and all what we are seeing around, the uncertainty basically on the long term, this is keeping, also the cost high. And, issuing debt is a question of demand and supply. You also have to meet, what investors want to buy. And so, in this uncertainty, obviously other things being equal, short-term debt and maybe inflation-linked could be something that is appreciated by investors.
Yeah, I don't know if you heard our prior segment. I was speaking to a European economist about the debt profile for Germany, but also other broader countries within the Eurozone as well. How are the OECD thinking about the potential uptick in bond issuance and subsequently in debt levels for these European nations?
I was listening to that, and then also the case of Germany. I mean, some people are, there is a lot of discussion in the market. It's true that what we have seen is this big spike in the yield, which is the highest since the 90s, I guess. But this is a sign of, I would say, of cost, not obviously of anything related to credit risk about, for example, Germany, which is a country that has by far one of the lowest, debt to GDP around the world. And then also we have seen that the reaction on the stock exchange was positive. The euro appreciated. Even, rating agencies said, okay, this is something that is not going to create an issue. But this is why, and this is one of the recipe of the report, is that what is important is that both government and corporate investment is done in let's say, a profitable investment, stable investment, investing in growth, and investing in something can repay debt. And obviously, defense is a large pot, but can also mean something that can be, I would say, positive in a sense.
Yeah. Would you say that if Europeans move towards more joint fiscal issuance, that would take the pressure off national governments' fiscal trajectory? How do you think about it from the OECD's perspective?
This is obviously something that can be relevant, important. Also, overall on the debt market, also strengthening maybe the role of the euro can alleviate other things being equal. Let's say alleviating national pressure for expenses that can be, in the common interest can be something which is quite could be important and interesting. Then we have to see what could be the end result, and also in terms of the values and the numbers we are talking about. Something is issuing a new expense, others are just raising the targets, and then we have to see if the targets will be used by these countries also issuing some more debt.
Yeah. One final question to round things up. USD, we know, is the world's reserve currency. There's been a lot of chatter amongst some academics about the trajectory of the US dollar for the remainder of this year, and the fact that the Trump administration does want to somehow devalue or cause a forced depreciation of the USD. How has dollar issuance showed up in some of the numbers that you've looked at? Are corporates and sovereigns still leaning on dollar funding, or are they moving towards other currencies?
Dollar is the reserve currency all around the world. Sovereign and corporates, when they are issuing also in foreign currency, issue there, especially many of the emerging markets and even the small markets, basically, they do not have necessarily a local market developed or a local market at all, so they have to issue in foreign currency, which is the dollar. This actually may also create some, in a sense, tensions on the market, because when you have a safe asset and then, a T-bill or others that you can buy at and having a very important, yield, then you can imagine how much you have to ask to buy, let's say, a corporate or emerging market sovereign denominated in dollars. So this is, I think, one of the issues that also we have to look for with attention, but the dollar, is there. Then obviously the effect of, for example, common denominated euro bonds can strengthen the role of the euro, even as a reserve currency. But this is still far to come.
Yeah, something to think about. Really good to have you on talking through your report. Carmine de Noia, Director for Financial and Enterprise Affairs at the OECD. Thank you. Well, plenty more coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Europe's race to boost its military capacity is facing a crucial hurdle. Defense firms are running short of gunpowder, TNT, and other explosives for weapons such as artillery shells and missiles. Bloomberg's Laura Alves has been looking at this and joins me now. Laura, talk us through what the supply situation actually does look like right now for propellants and explosives, especially with regard to the recent major defense spending plans that were announced out of Europe.
So when it comes to propellants, which is gunpowder, the part that drives the munition forward, and when it comes to explosives, which is what detonates, these parts, they have been identified as major bottlenecks for the European Union's ramp up of munitions production. And to respond to that, the EU has established some defense company funding programs, and they have also set ambitious targets to increase the production of propellants and explosives. But the issue here is that this does not yet match the new spending that we see both from Europe and also from certain nation states. So this will not be enough. And then also what we hear from companies is that they need to massively ramp up as well. So for example, Rheinmetall, the German defense contractor, they're the biggest producer of propellants in Europe. And they have already said that in order to match this new spending, they will probably have to double their production of propellants throughout the coming years to produce up to 20,000 metric tons of gunpowder per year.
Okay, are there issues to do with supply chains that are affecting some of these ammunition components? Is it a matter of just sorting out those supply chains in order to ramp up volumes?
Yeah, certainly. The supply chain is the main issue because if we look at propellants and explosives, there are many different materials and components that go into this. One example that can be named is cotton. Cotton is kind of the base product for propellants. Another example is nitric acid. So all of these products, they need to come from somewhere, right? And in the past, it wasn't really a priority that they would come from Europe. So they would very often be sourced from places where it's cheaper to produce them, such as, for example, China. So if we look at this from today's perspective, this is obviously a geostrategic concern and also a question that we need to answer with regard to European sovereignty. But then if we look at the finished products, at the producers of propellants and explosives, there are actually relatively few of these companies in Europe. So for example, there is just one single major TNT factory in Europe, in Poland, that needs to serve the entire market. And producers of other specialty chemicals, they're also getting to a point where they are facing unparalleled demand that they're really struggling to meet.
And very quickly, what do you think can be done to mitigate problems with some of these supplies of propellants?
So this is twofold if we look at the companies and if we look at the government. So if we look at the companies, what they can do is they can try to Europeanize their supply chain. So for example, what Rheinmetall has been doing, they've been sourcing cotton linters, which is basically the production process that comes right after the raw cotton, a type of cotton fiber. They've been sourcing those cotton linters increasingly from Europe and from friendly countries. And they've also been stockpiling them. So they now have stocks of those cotton linters for several years to go if it would have to come to that. And then governments, they really need to take the upstream supply chain issues into account. They need to not only focus on the propellants and on the explosives, but also on everything that goes into them.
Yeah. Bloomberg's Laura Alves, thank you so much for the reporting. Fascinating. Well, the opening trade is up next. I'm going to be tracking the latest out of Heathrow, so stay tuned for that. This is Bloomberg.